It's another day. We continue with the review of the business data analytics, the August 2025 sitting. If you are new to this channel, kindly consider subscribing. So far, we have reviewed two questions. That is question number 21 for published financial statement and question number 24 for audit schedule. So if you are yet to watch this, kindly visit our channel so that you can be able to watch these and follow these. So for today we review question number 23. This was for management accounting. Question number 23, it was dealing with management accounting, and I will read through the question, then we tackle it. You are the management accountant of Malas Tech Limited, a company that produces two types of product, that is alpha and beta. The company wants to understand the cost structure and profitability of both product as well as the break-even point based on the following data for the month of July 2025. So I've been given the product alpha and product beta, the selling price, the variable cost, fixed cost, and the unit sold. You are required to prepare contribution margin statement and net profit for each product. Calculate the break-even point in units and revenue for both product alpha and product beta. Calculate the margin of safety, that is in units and percentage for both products. Perform a sensitivity analysis by calculating how a 10% favorable change in all product data other than fixed cost for both product affects the contribution margin and break-even point. So we shall perform a sensitivity analysis on the variables apart from the fixed cost. So we shall start with the first one when we are answering our question. Number A, we prepare contribution margin statement and the net profit contribution margin statement. So shall start with the total sales. So contribution margin statement. Yeah, so we shall look at the two product alpha and the beta. Product alpha and product beta, the two of them that way. We shall start with our sales. Total sales. Total sales, and we know total sales, it will be units sold multiplied by the selling price per unit. Units sold and you multiply by the selling price per unit, and the same will apply to this. When you double click, you'll find that it has taken the 1/2 by 900 that way, and this one I'll just put shillings in thousand that way. Then we have the total variable cost. Total variable cost. Variable cost. So for the variable cost, the same thing. The unit sold by the variable cost per unit. By the variable cost per unit. That way. And you'll get your contribution. Total contribution. So the total contribution. Total contribution. So total contribution. Contribution. So contribution is sales minus variable cost. That way. So that will be our total contribution for the two. Total contribution for the two. Then we less the fixed cost. Less fixed cost. Less fixed cost. Fixed cost, and fixed cost already have been given here, 200, and the other one is 300. So we get the net profit. Net profit. So that is our contribution margin statement and the net profit for each particular product. For each particular product, we have 400, and the other one 400 and 180 as our what? Net profit. So this is our contribution. We can bold that, and we bold these. Yeah, that is the total contribution and the net profit. That is how the first part for 6 marks was supposed to be done. First part, number A. Then we go to number B, where we need to calculate the break-even point in units for both product in units and in revenue. So remember, we said the BP in units is equals to fixed cost. The fixed cost over contribution margin and BP in shillings. BP in shillings is equals to fixed cost over contribution margin ratio over contribution margin ratio, or normally say here, or BP. So BP in it is equals to, yeah, can change from here, BP in units multiplied by selling price. BP in units multiplied by the selling price. And we normally talk about the CMR, contribution margin ratio. This is equals to selling price over, not selling price, is equals to contribution over selling price. Contribution over selling price. So whichever method you use, still you'll arrive at the same answer. So we need the break-even in both the units and in revenue. So the easier one will be using these BP in units and you multiply by the selling price, it will still be the same. So we are having the product alpha and product beta, and what we have here, we have the selling price per unit, and you have the variable cost per unit. You just drag that, you get the contribution here, contribution per unit. We'll have our contribution per unit that way. So that is our contribution per unit, the contribution per unit, and therefore with the contribution per unit, and we have the fixed cost. You can bring the fixed cost here. Yeah. So the fixed cost, we have it here. That is the fixed cost that we are having, so that from there now we can be able to get our BP in units. Let me just get it here. Our break-even point in units, break-even point in units. We have said is fixed cost, and we divide by contribution margin, fixed cost over contribution margin. That way. So one will be 500 units and the other one will be 750 units. And break-even point in shillings, in revenue, the one that they need in revenue, break-even point in units and revenue. So in revenue, we have said we multiply this by the selling price. Multiply it by the selling price. That way. That is the easier one, multiplying it by the selling price. Or if you're not multiplying it by the selling price, you can use this. You find the CMR. If you are to find the CMR, contribution margin ratio. So if you are to find the contribution margin ratio for the two products alpha and product beta, so you'll find that here we have said is contribution, we have gotten this over selling price, which is 700, and here So this is 400 over, not multiplication, that way. And this one, it will be this. Both of them, they have the same contribution. Divide by this, that way. And therefore here, our BP will be the fixed cost. And now we divide by this. And the same here. The fixed cost, we divide by this. And you'll find that both of them, they will end up giving you the same answer. Whether you're using this or you go directly by multiplying by the selling price, you will end up having the same answer. You will end up having the same answer to that particular question. The same answer, you will arrive at it, the same answer. Yeah, that way. So we go to the other part. That one, you're done with part B. We go now to part C of our question. And for part C, calculate the margin of safety in units and percentage for both products. Yeah, margin of safety. When we talk about the margin of safety is equals to normal sales. Normal sales minus BP sales, break-even point sales. Break-even point sales. Yeah, normal sales and you minus break-even point sales. Normal sales minus break-even point sales. That one will give you the margin of safety. So I do for both product alpha and product beta. Yeah, so shall have our normal sales. Whatever we have been given as our normal sales, you either determine, so calculate the break-even. Where is it? Yeah, calculate the margin of safety in units and percentage. They need it in units. So our normal sales, so these are in units. They are in units. What you are having, the unit sold, we sold 1.5 and the other one we sold 1.2, and BP units. So the BP units, here we had 500 and here we had 750, that way. So that our margin of safety units will be the difference between the two, 1,000 and 450. Then margin of safety percentage, it is a percentage of normal sales. Margin of safety percentage, normally percentage of normal sales. So you take this and you divide by the normal sales, and you autofill this, convert that to percentage. So we had 67% and 38% as our margin of safety. Yeah, that way. So that is how it was supposed to be done. That way. Then the next thing now, the last part, I believe so, number D is whereby you are supposed to perform sensitivity analysis by calculating how a 10% favorable change in all product data other than fixed cost for both products affects the contribution margin and break-even point. Yeah, so the contribution margin and break-even point. So here the key thing is the contribution margin and the break-even point. So you can decide to go with the break-even point in units, yeah, or even in shillings, whichever. Still you'll be able to get that, but remember the sensitivity is 10% favorable change. So we shall start with 10% favorable change in selling price. Yeah, so we start with the selling price. selling price, what will happen if selling price increases by 10%? 10% favorable change for the selling price. Still the two products. So our selling price now will be, can base with the original. So this will be, we take the original selling price and multiply by 1 plus. I think that will be the better way. 1 plus the 10%, which I will lock so that I will drag. We'll get that one will be 770 and this other one will be 990. When you increase, remember the other one was 900, 990. Yeah, it will increase to that. The variable cost remains constant. Remember, variable cost doesn't change. When you're dealing with sensitivity, we vary one item at a time. We vary one item at a time to get our contribution margin. Our contribution margin. To perform sensitivity analysis by calculating how a 10% favorable change in all product data, all product data other than fixed cost for both product affects contribution margin and the break-even point. Contribution margin and the break-even point. Okay, so we shall see that. So contribution margin, therefore, in this case, it will be this minus this, and we'll get our contribution margin to be that way, because I just need the contribution margin and the break-even point. Okay, so assuming we go with the original, because even it's all of them that are being affected, our normal sales, assuming the unit sold, this one is not changing. The total sales or total contribution here will be this by this, and we drag this that way. The total contribution will be that, of which this one will not have any effect, and the fixed costs, just don't see where it will have an impact. We get the net profit, because we are not interested with the net profit. Remember, we are not interested in the net profit. Just need to see what will be the impact. That way, we are just interested in what? We're interested with perform a sensitivity analysis by calculating how a 10% favorable change in all product data other than fixed cost for both products affects the contribution margin and break-even point. Contribution margin and break-even point. So when you look at our BP under this one, our break-even point. I will go with unit because the marks are just 6 marks. Break-even point in units. So this will be the fixed cost that we have, and we divide by the contribution, the new contribution margin, that way. And we shall look at the percentage change in contribution, and percentage change in BP, so that we can know how it affects. So in contribution, it is increasing to 470. The initial contribution that we had, per unit, the one that we have used here in part B, initial contribution was 400, divided by 400, that way, and this one you convert to percentage, so it increases by 18%. It increases by 18%. Don't know whether it will affect this. Let's see this one, 490 minus 400. I think that one is okay, divided by 400. Yeah, so 23%. So for the BEP, the break-even point now is this, the new one, this minus the original BEP, which was this one, divided by the original BEP. So this one has reduced that way in percentage. So if we increase, if selling price increases by 10%, the effect now when you are performing the sensitivity analysis, if selling price increases by 10%, the contribution will increase by 18% for product alpha and 23% for product beta, whereas the BEP break-even will reduce by 15%. The units that are required to break even, they will be less, 15% and 18%. That is how sensitive the two are to selling price. So we go now to the other, that was the selling price. That was the selling price. We go to variable cost. Variable cost. So variable cost, the variable cost, and remember this is favorable. Yeah, variable cost, favorable, alpha, and these are the one. The selling price will remain. The selling price will remain the original one. Selling price will not change, but variable cost will change. Variable cost will change. I'll pick, let me pick this here, the variable cost that I have here. I had variable cost of this multiplied by 1 minus favorable, it will reduce by 10%, and I will lock this, so that will get to 70 and 450. You'll get your contribution here, contribution margin, that way. Yeah, so both of them will be having the same, in this case 450, not the same, 450 and 430 as our contribution margin. Remember, they are the only two that will have an effect on the BEP. Yeah, the selling price, the sales units, even if they increase, they will not have an effect. Yeah, that way. So that after that, so the unit sold is not a must to change unless you want to see how the profit will change. Yeah, assuming we just include that, but there is no effect on that. The unit sold, which will be 15 and 12, 15 and 12, so that the total contribution here now becomes this by this, that way, and you less a fixed cost of 2, where is it? So total contribution, so the fixed cost is here, these two, and you get the net profit. This is just a formality, it's not a must to do that, because the sales units will not have an effect. Sales units will not have an effect on the contribution. So the break even here, the BP in units, will now be our fixed cost, we divide by the contribution margin, that way, and we can round it off, that way. That will be our break even point in units, and we go to the percentage change, in contribution and BP. So contribution in this case, the new contribution is this, and you minus the original in B, the original contribution, which was 400 over 400, and you drag out of fill this, convert that 8%, and this one, the break-even point, and you minus the original in B, the original break-even point, divided by the original break-even point, and you drag, that way. So you'll find that if variable cost reduces, favorable, remember for the variable it will reduce. If variable cost reduces by 10%, break-even point will increase to 465. Remember here it was 426, it will increase, and this one will be 667. So percentage change contribution will increase by 8, and the other one by 13%, while the percentage change in break-even point 7%, and the other one it will reduce by 11%. That is if we change that. So the other variable that will not have an effect on break-even point is the selling price. The sales units. Remember the sales units sold. When you look at the units sold, this one will not have an effect. The unit sold doesn't have any impetus on the break-even point. And we are calculating the break-even point. It will not affect, because we just need the fixed cost of the contribution. So that one, it will not have any effect. When you do that, it means the only thing that will change, when you look at the initial statement in B that we had here, this one will remain. It will I'll use the very first. Let me use this. That one will remain up to this point. The contribution per unit, this one will not change. Remember, we do vary one item at a time. The units sold, these are the ones that will change. Here it will be this, and we multiply by 1 plus 10%. They will increase because it's favorable. It will increase to that way. So the total contribution here will be this by this. So total contribution that way, and after total contribution we less the fixed cost, and here the fixed cost will remain. Remember, fixed cost is not changing, it will remain, and you get the net profit. So you get the net profit here. So this minus this, the net profit that way, and we'll find that here there is no any connection between the net profit or the change. When you change the units sold, it will not affect the break-even point in units. The break-even point in units, they will remain the same. Here. If that one changes, remember our BP in units here will still remain the original. Of 500 and 750, and therefore the percentage change will be 0. Percentage change will be 0 here. Percentage change will be 0. So it will be 0 because it is this minus the original. The original was the same value, 500 divided by 500. You just get 0. So this one was not, there was no need of even calculating these, because both of them will be 0. So this was the one for contribution, and this other, both of them will be 0. it will be 0 because there is no connection between the unit sold and the break-even point. That is how that question was supposed to be done. That's how the question was supposed to be done. So the key thing was the selling price and the variable cost. You just need to see how the change will affect the break-even point in units and even the contribution margin, how they were supposed to be affected, how sensitive they were to change in 10%, change in 10%. So that's all. If you are yet to subscribe to this channel, kindly consider subscribing. Thank you.